Okay, so we're going to work some problems with Chapter 7 and this property transactions. Most of this is about acquisitions and determining the basis, and then some simple gains or loss scenarios based on those differences in the methods of acquisition or the basis calcs. So let's see. We're going to start with this exercise 7.1. And so this one says Peyton sells an office building and the associated land on May 1st of the current year. Under the terms of the sales contract, Peyton is to receive $1.6 million in cash. The purchaser is to assume Peyton's mortgage of $950,000. And to enable that purchaser to obtain the financing, Peyton is to pay $9,000 in points charged by the lender. Then also the last piece of information that's pertinent, the broker's commission on the sale is $75,000. So they're asking us to decide how much is the amount realized. And remember, that's kind of the term for the net proceeds that came from the sale. What did Peyton get from the deal net after it was all said and done? And so one of the things he got obviously was this $1.6 million cash. He got cash, obviously. So we take that. Then the next thing he got was a release from the debt on that property. So he transferred the property, and the purchaser assumed a mortgage of $950,000. So he not only got $1.6 million, but he also got the release from that loan. And so $1.6 million plus the $950,000 means his net proceeds so far, from what we've seen, is $2,550,000. That's this calc I've got here. And then from that, we have to reduce by the selling cost, the selling expenses. And so there's two pieces of the selling expense in this case. One was the commissions of $75,000 and that he paid to the broker. And then the other one is this points that he had to pay in order to transfer that loan over to the purchaser. And so those costs, 75 and 9 equals 84,000 selling expenses. Those reduce his proceeds down from 2,550,000 to 2,466,000. So the net amount he realized is this 2,466,000, and that's what they wanted. Just one number. The amount realized by Peyton is 2,466,000. Okay, so that was not too bad. You just have to know how to handle all these pieces. The next piece is the next problem is exercise 7.2. This one, Luciana, let me just go up just a little bit. Sorry, move some of this out of the way. All right, so the next one is Luciana is a non-shareholder, purchases a condominium from her employer for $85,000. The fair market value of the condominium is $120,000. So this right here is triggering something. As soon as you see that, it's worth $120,000. She bought it from her employer for $85,000. She got a bargain purchase from her employer. So that difference is automatically going to trigger in your head, uh-oh, I bet she has to pay tax on that discount they gave her. And surely that's what the issue is here. And it changes her basis to where her basis, rather than being the 85 she wrote the check for, it is the whole 120,000, because she's going to have to pay tax on the extra as compensation. And so that's going to increase her basis. And so the basis in the condominium is the full 120, and that's just because it's the amount that she paid plus the amount she had to pick up as income for the bargain. Paid 85. What was it? She sold it for, yeah, 85 plus reported as income, the extra difference between it, 35. So that's total of 120. That's how she got the total basis back up to the fair market value. And then they're asking us, what is her basis in the condo? We're going to say 120,000. Then they're asking us, she's going to report how much the discount, the bargain price, the price that they discounted for her. So 35,000, the difference between the fair market value and the price she paid. So they want us to say the basis in the condo is 120,000. She reports 35,000 as additional compensation. So they're just going to show that on her W-2 if they do it right. They'll just include that as part of her wage. So that was not too bad. It's just trying to make sure you understand that. I'm not sure what page this was on, or if it was in the chapter, but it's definitely in this exercise. So it just makes sense. We've seen this kind of thing before. If services are involved, they're usually, if they're buying something for you, they are taxable as compensation. Okay, and so then 7.8 is the next one. This one is Constanza, and she's single, sells her current personal residence with an adjusted basis of 165 for 450,000. Has a nice gain. She has owned and lived in the house for 30 years, and her selling expenses are 22.5. So this is talking about that scenario where you can exclude, not even defer, just totally exclude and never pay tax on gain on a personal residence, up to 500,000 for a married couple and up to 250,000 for other taxpayers. And so the kicker is that makes you qualify is you have to have lived in this home as a personal residence for at least 2 out of the last 5 years, and you have to you can't do it more often than every 2 years. So there's got to be 2 years between the times you ever would utilize this. And it has to be sold as a personal residence, not some alternative use. But this problem doesn't mention alternative use at all that they sold it for an alternative use. So we're assuming it was sold as a personal residence. And so she should be fine because she's lived there for 30 years. So she's going to be able to exclude $250,000 of gain. But before we do that, we have to see how much did she realize, then how much is her gain. The amount realized is just straight up this time 450,000. That's the proceeds, and then the gain realized. We need to know her recognized gain and her realized gain. Recognized gain is how much did she actually make, and then the realized gain is how much did she actually make gain on this transaction. And then the recognized gain is how much does she have to pay tax on. And so the realized gain, we just take the proceeds of 450,000 and reduce it by her selling expenses, which they told us were 22.5. So she winds up with a realized gain of 427.5. Amount realized 427.5, and we reduce that by her basis. They gave it to us at 165. So the realized gain is the amount she realized, the 427.5 minus her basis of 165. So that brought us to a realized gain of 262.5 right here. Realized gain. So then of the amount realized, how much does she have to pay tax on? It's just straight up. She's a single person. They told us that. So she gets to exclude 250,000 because it's a personal residence. The other will be taxed. So for the recognized gain, we take her realized gain and we reduce it by the excludable gain. There's a Z in there somewhere. Yeah. So 250 excluded. And the part that's taxed is the excess, 12,500. So that's all they wanted. What is Constanza's realized and recognized gain? The realized is 262.5, as we just calculated, and the recognized gain is 12,500. So really nothing to that. Very straightforward. As long as you know what the rules are, you're good. And then the last one we'll do on this chapter is problem 714. This is Roberto has received various gifts over the years. He decided to dispose of the following assets he received as gifts in the transactions indicated below. Determine the recognized gain or loss from the following transactions, assuming no gift was paid, no gift tax was paid when the gifts were made. So as you know, on gifts, if a gift was made where the value is more than the donor's basis, then we would use the carryover basis of the donor's that the donor held the property for. So in other words, our basis would be, if we were the recipient of the gift, our basis would be the same as in the hands of the donor. But we could also increase it by the amount of gift tax the donor had to pay on the transfer if there were some. And so they're telling us there's no gift tax because they know that we're probably aware that we could add the gift tax to the basis if there was such. But they're just saying, don't worry about the gift tax. We're not going to go there. So what we're going to do is go by the rule that stands that says if the fair market value exceeds the donor's basis, then we will use for the donee, the recipient, we will use the same basis as in the hands of the donor. And so but then again, if these four problems show you some different scenarios. If the fair market value of that gift that's given is less than the donor's basis, then we have what's called a dual basis. We have a basis if there's a gain someday down the road, and then we have a different basis if there's a loss somewhere down the road. We even have a third possibility where we have a kind of subjective arbitrary basis that gets used, substitute basis that gets used in order to produce a zero gain if the value lands somewhere between the fair market value on the date of gift and the donor's basis. So those rules we already went over, but we're going to apply them now, and that's what's happening in this problem. Okay, so we're going to use four scenarios, starting with A. In 1987, he received land worth $32,000. The donor's adjusted basis was $35,000, and he sells the land for $95,000. So the first thing is, do we have a carryover basis, or do we have to use the dual basis? So the first thing is you look at the land, it's worth $32,000. That's the fair market value when they say what it's worth. And his basis is $35,000. So since the donor basis is higher than the value at the time of the gift, that means we have to use the dual basis. That means we have to know, is this going to be a gain or loss? So looking at it, if he's going to sell it down the road quite a while longer, as you see, he got it in 87, he's selling it in 2022. So way down the road, he has a gain. So since he has a gain, we have to use his gain basis. And so his gain basis is going to be the adjusted basis in the hands of the donor. So that means we're going to be able to just take the amount realized, the $95,000, subtract the donor's basis, because we get to use carryover basis if there's a gain in the later on down the road. Okay, so that's nothing to this. It's just as if the value had been higher than the donor's basis at the time of the gift, because you get to use your carryover basis. And so the donor's basis is our basis because we have a gain. And so 95 minus 35 for the donor's basis means we're left with a taxable gain, also known as a recognized gain, at $60,000. Okay, so that's the first scenario. The next scenario would be in 1992. Oh, come on, you can do it. In 1992, he received stock in Gold Company. The donor's adjusted basis was $19,000, and the fair market value of that on that date of the gift was $34,000. So in this case, the fair market value exceeds the basis, so we are going to be able to use the carryover basis. So our basis is the same as in the hands of the donor if we're the recipient, and that means our basis is $19,000. So if we're selling it for $40,000 and our basis is the carryover basis, we'll put a little parentheses there, of $19,000, we just straight up have a $21,000 taxable gain, and it's all good. So that's what they wanted, $21,000. And so they're asking us to say whether there's a gain or loss in each of these. So far we just have gain. Okay, if I in my little scenario, if it's a loss, I'm putting in brackets. Okay, so now the next situation. In 1988, he received land worth $15,000. Donor's basis was $20,000. So here we go. This is a dual basis problem because it has a value lower than the donor's basis. So Robert's going to ultimately sell it then way down the road for less. So he sells it for $9,000. This is pretty rare for land, but it does happen sometimes. But in any case, they're telling us this problem, the land was sold for $9,000, which is a loss. So on the dual basis, if it's a loss, you use the value of the date of the transfer. So the $15,000 is going to be our basis. They wouldn't let us use the 20 and produce a higher loss. So they're limiting our loss by doing it this way. They're telling us if we sold it for less than the value on the date of the gift, then or less than either of these two values, then we aren't going to be able to use the carryover basis. So we have a loss basis of $15,000. We take $9,000 sales price minus 15. That gives us a loss of $6,000. So in C, they want it to say it's a loss of $6,000 is recognized. So those two are straight up if it's a gain, use the carryover. That's what we did in B. If it's a loss, use the fair market value at the date of the transfer. Okay, so here's our strange little third option, or I guess it's a fourth option. There's three options if you have lost property or property that's lower at the date of the transfer, and there's one option if there's property, if the fair market value is higher, or if the property is appreciated. These last three scenarios were, or the other three scenarios where there's loss basis is required or dual basis is required, are instances where the property was devalued at the date of the gift. But in any case, this fourth one, it's got the fourth scenario that causes this substitute basis. In 2019, he received stock worth $30,000. Donor's basis was 42, so it requires dual basis rules. Roberto sells the stock for 38,000. So because he sold it for an amount between the values of the basis at the date of the transfer and the fair market value at the date of the transfer, then we're required to do this arbitrary substitute basis that forces the basis to be the same as the sales price. So this 38,000 he sold it for triggers us to show the basis at 38,000 as well. So it's not that it's just a coincidence that it's 38. It's forced to be whatever the sales price is when the sales price lands between the two values of fair market value on the day of the transfer and adjusted basis to the donor on the day of the transfer. So this means we're going to have zero gain. We're going to force the basis number to be the same as the amount realized. So they're just asking for, right here, the result was no gain or loss of zero. So that's all I have on this one. So I'm going to come back and share some more later on in a different chapter.